Forget everything you think you know about Florida real estate. The market in 2026 will not look like 2021, 2022, or even what you're seeing today. If you're still using pandemic-era logic to make decisions, you're already behind. The next phase isn't a crash, and it's not another boom. It's something far more dangerous, a divided market where some areas quietly bleed value while others become so expensive they're practically untouchable. If you want to understand where Florida is headed in 2026, you have to stop thinking in headlines and start thinking in terms of capital flows, insurance math, demographics, and debt cycles. Stick with me until the end of this video because by the time the mainstream media admits what's happening, the best opportunities and the biggest risks will already be locked in. And when this all clicks, I want to hear your take in the comments because Florida is about to separate the informed investors from the emotional buyers in a way we haven't seen before. Let's start with an uncomfortable truth. Florida is no longer driven primarily by local incomes. That shift alone changes everything. In 2026, Florida real estate will be fueled by external capital. Retirees relocating with equity, investors escaping high-tax states, foreign buyers hedging against their own currency risk, and corporations moving their headquarters and workforce here. This means traditional affordability metrics are broken. Median wages in Miami, Tampa, Orlando, or along the South Florida coast no longer set the prices. Asset migration does. When capital moves faster than wages, prices detach from local fundamentals, but not everywhere at once. Some areas inflate permanently, while others quietly stall out. Now let's layer on interest rates. Even if rates ease a bit in 2026, the era of ultra-cheap money is over. This is a huge deal because Florida is one of the most payment-sensitive housing markets in the entire country. Why? Because a huge portion of buyers rely on leverage, second homes, or rental income to justify their purchases. Higher for longer rates compress that affordability and push speculative buyers out of the market. That's why transaction volume has already slowed down. It's not because demand disappeared, but because the marginal buyers were priced out. In 2026, this creates a market where prices don't collapse across the board, but liquidity dries up in certain pockets. Homes will still sell, just not every home, and not at any price. And then there's the elephant in the room, insurance. It's the single biggest factor that most buyers don't truly understand. Property insurance premiums have doubled or even tripled in some regions. Some major insurers have packed up and left the state entirely. Others are imposing massive deductibles that can cripple a homeowner. In 2026, insurance costs will act like a shadow interest rate, raising the monthly cost of ownership even if mortgage rates happen to fall. This disproportionately hits condos, coastal properties, older homes, and anything near a flood zone. As a result, two identical homes in the same city can have wildly different carrying costs, and therefore wildly different values. This is where Florida's market truly fractures. Inland properties with newer construction, lower insurance exposure, and stable HOAs will outperform. But coastal condos with deferred maintenance, skyrocketing HOA fees, and insurance uncertainty will underperform, even if they look cheap on paper. This isn't a theory, it's already happening. We are already seeing condo special assessments completely wipe out the equity gains homeowners made over the last 5 years. In 2026, that trend will accelerate, especially as new inspection laws and reserve requirements hit older buildings. Florida real estate is no longer just about location. It's about liability. Now let's talk about supply because this is where most people get it wrong. Florida does not have a housing shortage in the way you might think. It has a misallocation problem. Builders responded aggressively to the pandemic-era demand, especially in suburban and exurban areas. Thousands of new units are coming online, but they're not always where the demand is strongest. In 2026, there is a real risk of oversupply in certain price bands and regions, particularly for entry-level condos, zones saturated with short-term rentals, and investor-dominated new developments. Meanwhile, true single-family homes in top-rated school districts, near major employment hubs, and outside of high-risk insurance zones will remain structurally undersupplied. Same state, completely different outcomes. Short-term rentals deserve their own special attention. Florida became one of the most Airbnb-saturated markets in the entire country. In 2026, that business model is under serious pressure. Local governments are tightening regulations. Insurance costs for these properties are rising sharply. Tourism growth is returning to normal levels, and the competition among hosts is intense. This doesn't mean short-term rentals will disappear, but it does mean the incredible returns are compressing. Investors who bought properties assuming 2021 level occupancy and pricing are now exposed. Properties that only make financial sense as a short-term rental and not as a long-term home for a local resident will face valuation pressure. This is critical because it will create forced sellers in very specific pockets of the market. Finally, let's add demographics, the quiet driver of everything. Florida continues to attract retirees, but their profile is changing. Many are now older, more financially conservative, and far less willing to take on high HOA fees or massive insurance risks. At the same time, younger professionals are relocating for tax reasons, but they are very price-sensitive and highly mobile. This creates strong demand for rentals and mid-range housing, not necessarily for luxury excess. In 2026, the strongest segment of Florida real estate won't be ultra-luxury penthouses or speculative flips. It will be functional housing, livable, insurable, rentable, and low friction. Here's the part that most people will never hear. Florida real estate in 2026 is no longer a pure housing market. It's a capital preservation market. Buyers aren't just asking, "Can I afford this?" They're asking, "Will this asset protect my wealth from taxes, inflation, and policy risk?" That mindset supports high prices, but it also raises the standards for what people are willing to buy. Properties that fail this new capital preservation test will get punished, and fast. This leads us to the biggest misconception of all, that Florida is due for a crash. Crashes happen when leverage collapses across the entire system. That's not what's happening here. What's happening is segmentation. Weak properties will reprice quietly. Strong, desirable properties will become even more scarce and illiquid. The middle of the market will thin out. This is actually more dangerous than a crash because it tricks many buyers into thinking everything is fine until they realize their specific asset is the wrong one. So if you're watching this and thinking about Florida real estate in 2026, whether you're an investor, buyer, seller, or renter, you need to understand this. Success is no longer about timing the market. It's about selecting the right side of the split. Stay with me because in the next section, I'm going to break down exactly which Florida markets, property types, and buyer profiles will win in 2026, and which ones are set to quietly lose, even if the headlines never report a crash.